Hello and welcome to the Adansonia Capital Global Opportunities Portfolio Update for June 2025. This is our disclaimer. Please read it at your leisure. To move forward, I will take it as read. So the portfolio finished the financial year on a strong note, with both a strong absolute and relative return to the index for June 2025, up just over 3%. It also capped off a strong June quarter with a portfolio returning 8.3% versus the market as we define it 5.8%. A good year overall for the financial year. The portfolio pretty much in line or a little bit under the market at 17.4%. And since inception, which is now around 6.5 years, the portfolio is returning just under 16.5%, outperforming the market by 1.5%. The performance since inception, as I said, 6.5 years ago, is here graphically, if of interest. So, given we're starting a new financial year, I thought I'd basically talk about our outlook for financial 26. And it very much follows on from the note which we did a tariff note which we did a few months back. So essentially, we believe that the worst is behind us insofar as financial markets are concerned. And as you'd be aware that all stock markets are now basically bouncing off record highs or near record highs. The VIX index, which is the fear index or the volatility index, is back under 17 after peaking at over 50 around the Liberation Day announcements. So basically it shows that the level of risk appetite has basically normalized within the market. And also 10-year treasury rates have steadied around or under 4.5%, which is pretty much in the middle of the year's trading range. Importantly, the March quarter corporate results of financial reporting season for March was particularly strong, stronger than what the market was expecting and we were expecting. But again, the benefit of this was not fully seen in share prices, obviously, with the tariff issues overhanging the market still. Again, from the note which we spoke about, we believe that if you actually start to put numbers around the Trump tariffs, it's not as bad as what the market originally basically was pricing. Again, if we assume constructive trade agreements are set around a baseline rate of 10%, which was largely just done now in the UK, basically worldwide, with the exception of the Eurozone, where, as we spoke about before, that is closer to 20. And obviously we're excluding China at the moment on this. We basically believe that the market is essentially set for a pretty good year. The logical way to think about the US tariffs is very much akin to a sales tax or a GST, as we've spoken about here before, although only imported goods. And we believe that this impost will also be partially absorbed by the exporter and of the US consumers. So the impact on the US economy is not really going to be that onerous, and we talk about that on the next page. The U.S. Treasury, or the Federal Reserve, stands to receive hundreds of billions of dollars, which will be funding the beautiful bill that's about to be passed, and should be reducing the budget deficit to an acceptable level of GDP. We believe closer to around 4%. So again, as we spoke about before, and in the note, it's true that the tariffs will raise the cost of imported goods in the U.S. But if we assume a baseline rate of 10% on $3 trillion worth of imports, which excludes China and EU, which in total are about another trillion of imports, that's about a $300 billion impost on a $30 trillion economy. So it's about an inflationary impact of about 1%. And as we basically spoke about before, we believe that exporters will carry a portion of this impost as well. So to the US consumer, to the US economy, it's a one-off impost of under 1% in terms of inflation. We also believe that as it's a one-off, the US Federal Reserve will look through this and any short-term inflationary impact and start to ease interest rates, which basically will be supportive for markets. Outside of the US, inflation in most countries has fallen to within most target ranges, and we've seen that interest rates have been falling precipitously. Essentially, within Australia, we're expecting 3 to 4 rates cuts, and we're expecting basically rate cuts within the US to start very soon as well. China is still basically problematic and is experiencing deflationary conditions, and that's also being exacerbated by Trump's tariffs. So it's making it imperative that it reaches a constructive trade deal with the US, and that will obviously be very positive for markets once that's done. So, from a big picture point of view, falling inflation and declining interest rates are constructed for risk assets, such as equities, and should basically put a tailwind behind stocks. Lowers interest rates and inflationary pressure is also positive from a bottom up perspective with respect to corporate profits, and should again basically end up seeing company valuations lifted, which is also positive for the outlook for markets. In terms of what we've done with the portfolio of late, we've employed some of the cash. Remember around Liberation Day, we had around 20%, and we've basically been reducing that cash level. We've essentially gone shopping again over the last month or so. We've reduced our cash within the portfolio to around 7% by increasing our holdings in Alphabet and Amazon. And we also opened a new position in Thermo Fisher Scientific, which basically is a company that services the biosciences industry. I'll talk about that company next month as the featured outlook. So again, we believe that the construct for markets is positive moving forward. Obviously, we're not saying that it won't be without volatility, but net we expect a positive outlook for financial 26 and have positioned the portfolio accordingly. Especially with respect to reporting season, as I mentioned before, our portfolio, the stocks within our portfolio, especially the larger holdings, had very, very good results, and that hasn't been fully reflected in share price moves, and we believe that is still yet to come, and obviously underpinning a good portfolio performance for us in the outlook. Anyway, that is the update for June 2025. As always, we thank you for your continued support, and are always available for a chat. Contact details are at the bottom right of this chart, either for Tony or for myself, or you can basically email us any questions on through the website on that address. Anyway, we shall speak in July. Thank you again.